Martin Lewis has just shaken up the entire retirement conversation again with his newest explanation on the £12,570 pension tax update. And honestly, this might be one of the most important things every pensioner, every soon-to-retire worker, and even every family member with elderly parents needs to hear right now, because the level of confusion surrounding this update has reached a new high, and people are panicking simply because the rules have become so tangled that nobody seems to understand what applies to who. And that's exactly why we're going to break everything down in the clearest, simplest, most understandable way possible, so that by the end of this video, you'll know exactly who's exempt, who's not, and why this update matters more than most people realize. The number at the center of this entire debate is £12,570. That's the personal allowance, the maximum amount of income you can receive before you're required to pay income tax. It doesn't matter whether that income comes from work, savings, private pensions, or the state pension. The tax system treats all of it as one number. And that's where the problem began, because as pensions continue to rise year after year, especially because of the triple lock, people have suddenly realized that their state pension might soon get close to or even push above that £12,570 limit, and the moment that happens, tax rules begin to kick in. So naturally, pensioners started to panic and think, does that mean I'm going to be taxed? Will I owe income tax even if I barely have enough to get through the month? And right on cue, Martin Lewis stepped in, not because the government explained things clearly, but because people overwhelmingly turned to him for answers. For weeks, he's been swamped with questions, flooded with emails, and bombarded with calls from confused pensioners asking the exact same thing over and over. If my state pension rises, does that mean I'm going to pay tax? Am I going to lose money? Am I going to get a tax bill I can't afford? And the good news is that Martin Lewis finally provided clarity, but not without pointing out just how messy, poorly communicated, and frustrating the entire situation has become. So let's cut straight through the noise and break down the truth. If the state pension is your one and only source of income, meaning you don't receive a private pension, you don't have a workplace pension, you don't get rental income, you don't receive interest from savings accounts, and you don't have any other taxable streams, then you are exempt from paying tax under the new update. That means if you rely entirely on the state pension and nothing else, the government will force you into paying tax even if the state pension rises close to or even slightly over the £12,570 allowance in the coming years. In other words, the most basic pension-only retirees, the ones living purely on the state pension, often the people with the least flexibility and the tightest budgets, are protected. But here's where the situation gets far more complicated, and this is exactly where most of the confusion has come from. The exemption only applies to people who have absolutely no other income at all. The moment you add anything else into the mix, even a small workplace pension from an old job, even a small private pension, even savings interest from a bank account, even rental income from a room you rent out, or even just a few hours of part-time work, all of that counts toward your total taxable income. This is what Martin Lewis has been trying to warn people about. Many pensioners think they're safe simply because their state pension alone is under the threshold. But when you add a small private pension, even one that's only £20 a week, it can suddenly push your yearly income over the allowance. And here's the twist that catches people off guard. Even if you only go £100 or £200 over the allowance, that small amount still becomes taxable, meaning HMRC can send letters, notices, or even tax bills for surprisingly small amounts. That's why Martin Lewis emphasized how important it is for pensioners to know their numbers, to actually add everything up instead of assuming anything. And let's be honest, the biggest problem here isn't the tax itself. It's the constant confusion caused by a frozen personal allowance combined with rising pensions. Because while pensions have been increasing due to the triple lock, the personal allowance has not been increasing at all. In fact, it has been frozen. And when one number rises and the other stays frozen, it creates what Martin Lewis calls fiscal drag, meaning more people are pulled into paying tax even though their real standard of living hasn't improved. It's like the government silently drags more and more people into the tax system without ever raising tax rates. They just let inflation and pension increases do the work for them. And pensioners are the ones caught in the middle of this quiet squeeze. But the government, under pressure, finally clarified that people who rely solely on the state pension won't be taxed for now, which is good news, but only for that specific group. Everyone else, which is the majority of pensioners, still needs to understand the rules carefully. For example, if you receive the state pension plus a small private pension, your combined income is added together and can easily cross £12,570. If that happens, the extra amount is taxable. Many pensioners don't realize this because they see each income separately, but HMRC sees them as one total. And this is why so many retirees end up shocked when they receive unexpected tax letters or underpayment notices, not because the system is wrong, but because the system is confusing. Martin Lewis stressed that many people who believe they're safe from tax may actually be just a few pounds away from crossing the line without knowing it. And he's right. A pensioner with the full state pension plus a small workplace pension might cross the threshold sooner than expected. So the key message he wants people to understand is simple. If you rely on the state pension, relax, you're exempt. But if you have even one additional income stream, no matter how small, you must check your total income so you aren't blindsided later. And although this update might sound like a simple clarification, the truth is that it reveals a much deeper problem. The UK's tax thresholds are completely out of touch with rising living costs and rising pension payments. The fact that pensioners are even getting close to the tax threshold shows how broken the freeze has become. Pensions rising while allowances stay frozen means more retirees will be pulled into tax every single year unless the government decides to raise the allowance. And based on the current situation, that doesn't seem likely anytime soon. Martin Lewis said very clearly that unless something changes in future budgets, more and more pensioners will slowly move into taxable territory, not because they're richer, but because the thresholds aren't moving. So the real danger isn't what's happening right now, but what could happen over the next few years. Today's exemption might protect pension-only retirees for now, but tomorrow's pension increases could push people well above the threshold. And if the exemption expires, the simplest, poorest pensioners could suddenly find themselves owing tax again. So the exemption is good news, but it's temporary good news. And that's why Martin Lewis keeps saying, keep paying attention, keep understanding your income sources, and don't assume rules will stay the same forever. For now, though, we finally have clarity. State pension only? You're exempt. State pension plus anything else? You need to calculate your total income. And if you cross £12,570, tax applies to the extra amount. It's simple once someone actually explains it properly. It's just a shame that it took Martin Lewis, not the government, to make it clear. But that's where things stand right now. And if you're a pensioner, or you know someone who is, this information could genuinely prevent stress, confusion, or unexpected bills. So stay informed, stay calm, and make sure you keep track of your income, because understanding these rules is the best way to stay ahead of any surprises the system might throw your way in the future.